What? Yes. Please.
Okay, so let me see. Okay, all right, let's continue. Okay, all right. I hope we can all hear me. Please, can you all hear me?
Yes, please.
Okay, very good. All right, let's continue. Yeah, so let's look at components of the financial statement. So we realized that, or we saw that the financial statement is made up of four main components. Okay, I think there's one more, which is the note. So we have the statement of profit or loss, the financial position, the statement of cash flow, and then the statement of changes in equity. Okay, so let's look at the statement of profit or loss, which is also called the income statement. Okay, so the income statement, what are the main components? So the income statement simply records or reports on your income and the expenses for the year, or sorry, for the period. Okay, and then to arrive at your profit or loss. Okay, so maybe income of 1,000, expenses of 700, your profits of 300. Okay, but when we take the expenses, there are different type of expenses. So repairs, maintenance, fuel, fuel, donation, rent. There are advertisements. Okay, even though these are the main components, but under expenses, there are a number of expenses. When we take the income to, we have a number of income items like sales, we have commission income, we have interest income, we have dividend income. Okay, so income also has its own subcategories. So what is an income? Okay, when we say income, what is it? Can anyone explain what income is? Okay, income. Okay, incoming. Yeah, what is income? Something that is coming in, isn't it? So what is income? Anyone to explain what income is? Hello? Anyone to try for us? Okay, income. What is it?
Hello, sir.
Yeah, hi.
Yes,
Yes.
please. So, in my thinking, income is the money that an organization or an individual receives or earns.
Okay. Okay, yes. Income is money or funds that an organization earns or receives. Yeah, that is correct. Yes. Yes, that's an inflow to the entity or the business or the organization. Okay, so yeah, but let's look at the formal definition of income. Okay. Income refers to anything that increases your assets. Okay. Anything that increases your assets. Okay. Or decreases your liabilities. Okay. Anything that increases your assets or reduce your liability. So, for instance, you have a bank. You have a bank account. Okay. You have a balance of, let's say, 1,000 cedis in your bank account. This 1,000 cedis is an asset to you. Okay, it's an asset to you. Let's say you have made some sales. Okay, you made sales of maybe 2,000, and the customer has paid for the sales. If the customer has paid for the sale, it's going to, and the customer has deposited the money in your bank account. So it means that your bank account is going to increase by 2,000. So when you add the two together, you get 3,000. Okay, so you can see that the sales has increased your assets from 1,000 to what, 3,000. Okay, so anything that increases your assets is an income, and reduces your liability is uh, is a form of income. Okay, so this is increase in assets. Okay, let's look at uh, reduction in liability. Let's say you owe supplier A, you owe your supplier 10,000. Okay, and now let me just a moment. Uh, okay, let's say you owe your supplier 10,000 cedis. Okay, the supplier says that, okay, I've forgiven you 2,000. Okay, I'm dashing you 2,000. You pay 8,000. Okay, now those 2,000 is an income to you. It's a form of income. Why can anyone explain why it is an income to you? Even though the supplier is not giving you the money, but it is an income. Can anyone explain why? Yes, Daniel, I think your hand is up. Can you?
Yeah, thank you. I think because it reduces your liability, so it counts an income.
Yes, yes, yes. It reduces your liability. Yes, it's an income. Yes, but there's the real main reason why it reduces your liability, which is correct, and also, so the supplier has given you value of 10,000. Maybe the supplier sends some goods with a value of 10,000, and even if you sold the goods for maybe 12,000, you have even made profits of 2,000 on the goods. Okay, the supplier sold the goods to you at 10,000. You sold it to at 12,000, and you have made profits of. Now the supplier says that, okay, instead of paying 10,000, you pay 8,000. You see. Meanwhile, you have sold the goods for what, 12,000. Now look at your profit. Now your profit will be how much? Will be 4,000.
4,000.
So because the supply has reduced your how much you have to pay, it has eventually increased your income by what? 4,000 to 4,000. So it becomes an income to you. Okay. So that is the definition of income. So first of all, your liability has reduced, which is good. Also, it has eventually increased your income. Okay, it has eventually increased your income. Then let's look at and then it will at the end of the day it will increase your equity. Okay, increase your equity. Equity is your profit. So if you look at the illustration here, you can see because of the reduction of 2,000, it has increased our profit to what? 4,000. So always remember that income also increases. Sorry, your income also increases your equity, which is your profit. Okay, income eventually increases your equity. Then we have expenses. Okay, expenses decrease your assets. Okay, and they increase your liability. So expense is the other way around. Okay, expenses always reduce your assets. Let's say you purchase an item. As you purchase, your bank account is reducing. Okay, all right. So that's an expense, and it's increased your liabilities. Okay, when you purchase an item of credit, it will increase your what? Liability, and expenses will eventually reduce your equity. Okay, or it eventually reduce your profits. Equity is the same as your profit. Yeah,
Hmm?
yeah. So that is income and expense. So in the income statement, you see these two main items: income and expenses. So let's look at the balance sheet or the statement of financial position. In the balance sheet, you see three main items. You see assets, equities, and liabilities. Assets, equities, and liabilities. Okay. So what is an asset? Can anyone explain what an asset is? Hi. Anyone to help out with the definition of assets? Anyone? What is an asset? Okay, someone. Yeah, Daniel. Okay, you have raised your hand. Can you?
Okay. So assets are those things that are owned by the company.
Okay, please
The
can you take
dogs,
it?
the dogs will be ready right now.
Oh,
So assets are those things that
Fried
are
rice grilled
owned by
chicken one.
please can you mute?
Hey,
Jollof
Who
grilled
is
chicken one.
and
making?
so that's what
Take
I'm
out.
It's asset a fried rice asset.
When you are there,
Please can you mute our microphones? Hello.
raffia. Assets. Influence.
Yes.
Hello,
Hi. Can we mute our microphones?
hello.
Hi. Hello. Yes. Okay, Daniel, can you take it again?
Hello.
Hi. Yes.
Okay, so
Yeah, please, assets are
Okay. All right. Please, you can go ahead.
those things that are owned by the company are referred to as assets.
assets are resources that are owned and controlled by an organization.
Okay. Yeah. Okay. Yes. So assets are resources owned and controlled by an organization. Okay. So the key word here is resources. Okay. Resources. And what are resources? Resources are resources are let me see refers to anything that brings that is used to solve a problem or anything that has some benefits. Okay, that gives you some form of benefit. It's a resource. Okay, so an asset is an economic resource. Okay, it's an asset is economic resource controlled by an entity. Okay, so the another important word is control. You should be able to have control over the use of the assets. Okay, as a result of past events. Okay, so assets are economic. The two main words are resources and control, and also benefits, economic benefits. Okay, so can we give examples of assets? The as definition. Can we get some examples of assets?
Yes, sir.
Okay, so can you give us one?
Motor vehicle,
Yes, motor
laptop,
vehicle, laptop. Yes, computers and accessories.
business premises,
Cash.
Buildings and then land.
Buildings and land. Good, yes. All these are.
Cash.
Please let's mute our microphones. Okay, buildings and land, yes. What else? Anything else?
Cash.
Cash, yes. Cash is an asset. Yes.
Goodwill.
Okay, goodwill is
Inventories.
yes. Inventories are assets, yes. Yeah. So there are so many assets. Okay. We have so they are grouped into two. We have tangible assets and intangible assets. So and then we have current assets and non-current assets. But they are all assets. Okay. Let's look at so according to the accounting equation, assets is equal to equity and liabilities. So your equity and your liabilities will give you your assets. Okay. All right. And what is equity? In simple terms, equity refers to your residual profit or income or your contribution, your capital and your profit into in the business. You know, every business starts with a profit. Start with a capital. Okay, start with a capital or equity or some form of seed fund. Okay, then liabilities. Liabilities are obligations. Obligation to deliver cash or other financial resources out of the company to another entity. Okay, so liabilities are obligations to deliver or to transfer an economic resource. Okay, so examples of liabilities are payables. Okay, payables are a typical examples of liabilities. So this equation is very important, and that is where double entry is coming from. Okay, and the basis of accounting is the double entry. You should know your debits and your credits. Okay, which items are debited, which items are credited. So you can see assets at the left side, equities and liabilities at the right side. So in the balance sheet, assets are debited. To increase an asset, it is debited. Okay. Then to increase your equity and liabilities, they are credited. Okay. The debits and the credits don't really have any intrinsic meaning. It's just to identify the the position of the item. Okay. But they don't really have an intrinsic meaning that okay when we debit an item, it means that oh we are maybe we are reducing the item or we are increasing the item. Because when as far as assets is concerned, debiting means we are increasing it. Uh, but debiting equity and liability means we are reducing it. But assets, when we are reducing it, we credit it. So it is a little bit confusing. Okay. But the debits and the credit is just to show you the positions of the the the, the items on the balance sheet. So assets are at the left side, so they are debited. If you want to increase it, they are debited. Equities are at the right. Equity and liabilities are at the right side. So if you want to increase it, you credit it. Do you get it? So that is the main difference between debit and credit. So assuming that you have made some sales, okay, cash sales of 1,000 cedis, and the customer has paid. The customer has paid the 1,000 cedis. So now your cash has increased. Okay. So can anyone help us with a double entry? Okay. Which item are we going to debit? Which item are we going to credit? Okay, anyone to help us? Yeah. So since our assets is increasing, our cash, we will debit the cash by 1,000. Then sales is revenue. Okay. And revenue increases our equity. Okay. And we said when equity is increasing, we credit it. Okay, so we credit um, our revenue or our sales. All right. So that's how the double entry looks like. Okay. So we are going to pause for a few minutes and we'll come back. We'll pause for like 15 minutes and we'll come back and continue with practicals. Okay, practical examples. Okay, so please, we are pausing for 15 minutes. So we'll come back at let me say 10:55 and then we'll continue. All right. So let's go for a break.
Cypress, what time are you closing for today?
We let me see. So let's close at 11:30. I think 11:30.
Okay. All right.
So we can go and continue our activities. Yeah. All right. So we will come back at 10:55. All right. Thank you.